Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please know this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Okay, so today, wow, the market really seemed to demand profits over pure potential. It felt like one of the sharpest post-earnings hits we've seen in tech this quarter.
Yeah, it really did. Kind of a reckoning, like you said. Definitely put a stop to the week's momentum.
But the broad market closed lower.
Sharply lower, yeah. The S&P 500 fell, 0.99% to 6,822.34. But the real action, the place to look, was the NASDAQ composite.
Got much more.
Much more. Dropped 1.57% to 23,581.14. But then look at the Dow Jones Industrial Average.
Almost flat.
Pretty much. Declined only 0.23%. That tiny loss. It tells you exactly where the market felt safer today. That split.
Yeah, that really defines the day, doesn't it? Seems like a major rethink is happening around the whole AI infrastructure investment story.
Absolutely. The market's basically saying, okay, show me the money, not just tell me about the future potential. Growth at any cost isn't flying right now.
And the biggest tech names really felt that shift.
Oh, definitely. Meta tumbled more than 11%. That's huge. And Microsoft, even though their underlying business looks strong, still fell roughly 3%.
And it wasn't really about bad earnings, was it? More about the spending plans.
Exactly. It was the outlook for future AI spending.
Yeah.
Investors saw those increased numbers and started questioning, the timeline. When do these massive investments actually translate into profits? Is the spending pace sustainable?
And the sheer scale of the investment is, well, it's staggering. Microsoft, Alphabet, Meta together, what was it, $78 billion in CapEx last quarter?
$78 billion just last quarter, and that's an 89% jump from a year ago, nearly double.
So the market isn't debating if AI is the future. The question today was, are these huge upfront costs being managed effectively? And critically, when will they actually boost the bottom line?
Which brings us back to that great divergence you mentioned. NASDAQ selling off, but investors finding refuge in the Dow.
The classic rotation. You saw profitable, cash-generating businesses holding up. Actually, 5 specific old economy stocks were responsible for almost all the Dow's relative strength.
Really? Which ones?
Well, Goldman Sachs gave the index a big lift, about 140 points. Then you had Visa, Sherwin-Williams, JP Morgan, and Caterpillar. Each added about 40 points.
Ah, so companies delivering predictable cash now. A very different story from the giant AI bets in tech.
Exactly. A stark contrast.
Let's get into those company specifics because the reaction to Meta was, well, pretty brutal. That 11% drop, their biggest fall since October 2022, felt like real fear.
The fear stems from the future guidance, the CapEx. Look, Zuckerberg defended the spending, but they lifted the 2025 CapEx range to $72 billion. That's up from a floor of $66 billion.
So they're accelerating spending.
Right. And the market read that acceleration as this massive, potentially very long-term bet. The question being asked is, basically, is the company spending investor money too aggressively without a clear path to making it back soon?
And the Reality Labs part of the business highlights that friction perfectly.
It really does. Think about it. Reality Labs brought in $470 million in revenue in Q3 2025. Sounds okay until you see the operating loss for the same period was $4.43 billion.
Billion with a B.
Billion with a B. So the market's signaling. If the main business needs this much more spending just to compete, and the side project is bleeding billions, maybe the cost of leading in AI is just too high right now.
But as you said, the market was discriminating. It wasn't just sell everything tech, look at Microsoft.
True. Microsoft declined, yes, but they beat earnings expectations. Net income was up to $27.7 billion. Now, they did have that $3.1 billion one-time hit from their OpenAI investment, which didn't help sentiment.
But analysts weren't panicking.
No, not entirely. Folks like JP Morgan are still constructive, keeping their overweight rating. They see the strength in Microsoft's cloud business, Azure. That $3.1 billion charge, while big, was a non-cash thing tied to an earlier valuation.
So the market wasn't punishing Microsoft's current performance?
More the pace of spending needed to maintain their lead. That seemed to be the concern.
And then you have Alphabet, the complete opposite reaction. Shares popped 2.5%.
That's the market rewarding quality execution. Alphabet demonstrated they could handle AI spending while delivering strong results right now. It showed that AI investment can yield positive financials more immediately if done well. That really set them apart from the meta-narrative.
Okay, shifting away from big tech earnings for a moment, we got another really interesting piece of information today, more about the consumer. Chipotle's warning.
Yeah, that was a big one. Chipotle shares plunged about 15%. Quite a drop.
15%. Why such a steep fall?
They cut their same-store sales forecast. Again, third straight quarter they've done it. Now they're expecting a decline for fiscal 2025, low single digits. That's a huge turnaround from where they started the year.
And the CEO was pretty blunt about it.
He was, quote, "The consumer slowdown is really affecting our business in a meaningful way," end quote.
Why is a pullback at Chipotle such a big deal? It's burritos, right?
Well, yes, but Chipotle is often seen as a bellwether for the more affluent consumer. It's not the cheapest option, It attracts middle to upper income folks.
The ones maybe less sensitive to price hikes?
Historically, yes. So when their CEO says all consumer groups are visiting less, that's a significant warning sign.
And they specifically called out the group making under $100,000 a year.
They did. That group is 40% of their base, and they're cutting back noticeably.
So if even the relatively well-off consumer, the Chipotle customer, is pulling back on discretionary spending.
Exactly. It raises questions about overall consumer health heading into the holidays. If that group feels squeezed enough to cut back on a relatively affordable treat like Chipotle, it suggests the broader economy might be slowing more than people thought.
This mix of tech spending worries and consumer weakness, it puts the Fed in a tricky spot, doesn't it? And Chair Powell certainly added to the uncertainty today.
He really did. I mean, the 25 basis point rate cut was expected. Everyone saw that coming. But the forward guidance, that was the surprise. A hawkish pivot?
How so?
He explicitly mentioned strongly differing views within the committee about December. And then the key line, a further rate cut in December, is not a foregone conclusion. Far from it.
Okay, so slamming the brakes on the idea that more cuts were guaranteed.
Instantly. You saw it in the markets. Traders immediately dialed back the odds for a December cut. Went from almost 90% probability down to around 67%, according to the CME FedWatch tool.
And bond yields reacted.
Yep. Yields moved higher. The 10-year Treasury yield rose over 3 basis points to 4.089%. The 2-year, which is more sensitive to Fed policy, jumped over 2 basis points to 3.61%. Bond investors are saying, hold on, this easing path isn't so clear anymore.
And the government shutdown isn't helping things, is it? Still going on, week 4 now.
Makes the Fed's job much harder. Powell himself admitted they don't have the full picture. He called the government data the gold standard for economic measurement.
So they're flying partially blind on key data like jobs and inflation.
Exactly. And Powell hinted that this lack of data might make them, quote, more cautious in December. It just adds another layer of uncertainty for markets.
While we're on policy, there was another significant announcement, maybe quieter, about quantitative tightening ending.
Yes, that's important. QT, where the Fed shrinks its balance sheet by letting bonds mature without reinvesting. They announced that process will officially stop on December 1st.
They've been shrinking it for a while, right?
Since mid-2022, they took the portfolio down from a peak of around $9 trillion to about $6.6 trillion now. So quite a reduction.
What's the significance of stopping QT now, especially with this caution on rates?
It signals the Fed feels okay about the current level of liquidity in the banking system. Ending QT removes a background tightening force. It suggests they're prioritizing financial stability, making sure markets function smoothly, over aggressively shrinking the money supply, especially given the economic uncertainties we've discussed.
Ensuring there's enough liquidity seems key right now. Okay, let's shift to commodities. Saw some interesting moves there, too. Crude oil kept falling.
Yeah, down almost another percent, just under $60 a barrel. Even those Russian sanctions last week didn't provide lasting support.
Why not?
The market seems focused on the bigger picture, structural oversupply. And you have forecasts like the EIA is predicting Brent crude could average just $52 a barrel in 2026. That kind of long-term bearish view tends to outweigh short-term disruptions.
But natural gas went the other way, rallied pretty strongly.
It did, up nearly 3%. That's mostly seasonal. Winter heating season is approaching. Storage levels are okay, about 5% above the 5-year average, but not overflowing. So as demand picks up, traders anticipate that buffer getting used, pushing prices up.
And gold. It had that massive plunge earlier this week. Did it find its footing?
Some stabilization, yeah. Gold rose about 0.5% today, consolidating around $3,950 an ounce. It suggests the underlying supports, central bank buying, geopolitical risk are still there. That crazy spike towards $4,380 was likely just overdone, so the correction was probably needed.
Okay, finally, what about crypto? Still feeling the pain after a disappointing October.
Definitely. Bitcoin fell another 3.5%, down near $109,373. Seems the main trigger was a big outflow from those U.S. Bitcoin spot ETFs on Wednesday.
Oh, right, the institutional money. How much left?
About $470.7 million flowed out in one day, nearly $500 million.
Wow. Was it broad-based?
It was concentrated in the big ones. Fidelity's FBTC saw the biggest outflows, then ARK and 21 shares ARKB and BlackRock's IBIT also saw significant withdrawals.
So this isn't just small investors taking profits.
No, this looks more like institutional rebalancing, maybe some year-end profit-taking. And Powell's hawkish comments certainly didn't help. Crypto, as a risk asset, really does like signals that easy money might be ending sooner than expected.
Okay, so wrapping up today, we've got skepticism about AI spending, worrying signs from the high-end consumer, and a Fed pulling back on rate cut certainty. Where does that leave us looking ahead to tomorrow?
All eyes are on Apple and Amazon's earnings after the bell tomorrow. That's the big one. Their results, and especially their CapEx guidance and cloud growth numbers, particularly AWS, will be crucial.
To see if the spending concern is just Meta and Microsoft or something bigger.
Exactly. Is this an industry-wide acceleration that the market just can't stomach right now? That's what everyone will be watching.
And looming over all of it is still the missing jobs report.
Still uncertain due to the shutdown. That delays the clarity the Fed needs for December, so expect continued caution from them until that data lands.
So, based on today, what are the scenarios we might see playing out?
Well, our base case, maybe 50% probability, is the market sort of chops around, consolidating in the 6,700 to 6,850 range for the S&P 500. Investors are just digesting everything, Fed uncertainty, mixed earnings. Volatility stays up, but maybe no huge moves until we get more clarity.
Okay, and the upside?
The bullish scenario, let's say 30% chance, Apple and Amazon deliver strong results without shocking CapEx hikes. Maybe we get positive news on the shutdown ending. That could see the S&P stabilize near 6,800.
And the downside risk?
The bearish scenario, maybe 20% probability, Apple or Amazon do aggressively raise their spending guidance. That confirms the industry acceleration fears, and you could see the S&P 500 push down to test that 6,600 support level.
Got it. Any key levels to keep an eye on technically?
For the S&P 500, watch support at 6,750, then 6,700. Resistance is up at 6,850, near Wednesday's close before the drop. For Bitcoin, support around $108,000 is key, with resistance near $111,000.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.